Hello, welcome everyone to Now Next Later for Monday, February 9th. I'm Jeremy Potter.
And I'm Sasha Stair.
Today, we're really excited to have Wendy Lee on the program, and we're very grateful to have Accelerate as today's sponsor. As you probably remember, Accelerate supports Now Next Later and is one of the cutting-edge technology platforms helping lenders turn leads into referrals into action that becomes lifetime value. So when we think of that intelligent data management, the use of consumer experience, the fact that you can trust that to bring people back in the future, we are grateful that Accelerate supports us. And so thank you for sponsoring today's show. And we have another announcement, as we've been saying for the last couple of shows. We want to have reoccurring guests. We want to have Wendy Lee coming back every second Monday of the month to talk to us about a huge area of innovation and importance for the mortgage industry. And of course, that's servicing, legal risk, compliance risk, and the lifetime value and retention that we're talking about already. So Wendy, thanks for being here.
Thanks for inviting me. I'm honored. It's going to be fun.
Absolutely. So Sasha and I were trying to think through, now that we get to have these ongoing conversations and we have so many topics to cover, where do we begin? So we were grateful that you said, and thankful that you said, why don't we begin with some cutting edge data, some new data that's just out. A lot of people ask you in particular about default delinquency numbers. Where's it going? What are the trends and risks? So let's start there. Can you kick us off with kind of where are we now with the delinquency, kind of the state of the world in mortgage delinquency?
Sounds great. So the latest MBA data that we have is from Q3 of 2025, which showed, mortgage delinquencies are kind of normalizing, that we are just kind of coming back to closer to pre-pandemic norms in terms of the amount of delinquencies. The total mortgage delinquency amount was 1.78% as of Q3 of 2025, which was up from 1.74% a year earlier, which is a really a tiny increase, right? If you look at it, and it's still well below the 11.49% crisis peak when we were in the great financial crisis. So if you look at it, we're just kind of coming back to normal. This morning, there's been some digestion of the ICE mortgage monitor and some of the data there. And it shows just for December alone, the national delinquency rate has dipped 16 basis points in December to 3.68%. And that's of, the data that's in the ICE mortgage monitor itself, which is, 26 basis points below the December 2019 pre-pandemic benchmark. One of the things that really stuck out though in the report is looking at where we're seeing an increase in negative equity. And that's a concept that we haven't heard a lot about lately because of the great rising of home prices and the amount of appreciation. And there's kind of this thought in the marketplace that everyone's got some equity to play with, so we're good. But in this report, it looks like there's 1.1 million homeowners or borrowers that have ended up underwater, and that's the highest level since early 2018. And negative equity seems to be mostly concentrated in FHA and VA portfolios that were originated in 2022 or later. That seems to be a sore spot right there. And it looks like there's some markets that are particularly showing high on this metric. And the two, the markets, if you look at overall states, it looks to be in Texas and in Florida. And so then when you go in deeper and you go, what exactly is going on here? It's hard to know. Some theories are that there's a lot of inventory in some of those spaces, and that you actually have to look at an MSA level and really what's happening in the major metros to decide. And so because those two states have some pretty major metros, they tend to swing the numbers. But one theory is that we've got some homes that are sitting. We've had a lot of development in those two states, and so with those homes sitting and prices coming down, that causes the negative equity situation from a valuation standpoint. You have to watch those numbers because homeowner incentives go away once they don't have equity. Although if they had a higher down, they have more skin in the game, they might likely ride it out. And of course, people don't just walk away from their homes. I think what we saw with the walk away behavior in the great financial crisis, a lot of it was because people had multiple homes. There were lots of different options. And I think right now the struggle is going to be real. What we're going to see is not just people saying, oh, well, it's I've got no equity, so I'm just gonna, here's the keys, lend or buy. No. What we're going to see is quite the opposite. I do think it's going to result in a much more intense battle at a highly contested rate. And I'll just kind of weave a little bit of technology into it. One of the trends that we've seen a dramatic uptick in the number of homeowners who are using AI to help themselves fight any attempts at collecting on their mortgage debt. And they're using all these tools to file lawsuits, to file letters, to really create, a lot of friction in the process, and seeking out the most that they can get, of course, in terms of loss mitigation. So there's a lot there to do in loss mitigation, certainly. And you certainly, as a servicer, want to take those steps before you go through and push it out into my world, into the foreclosure world.
Wendy, that's a lot to unpack. And I would say what I heard you, if I can recap it properly, what I heard you say was, yes, the numbers show delinquency is normalizing. However, there are definitely some signs of stress and pressure on the system where we could see them come back. Can you talk about what, either from logs perspective, like things you're seeing in your referral base, or other signs that you're seeing in the industry right now, maybe even with FHA loans? We had a lot of loan modifications during COVID. Those have kind of come to a complete, partial claims, et cetera, student loans, et cetera. There's a lot that has changed. So like when you look at that overall structure, what other signals are you seeing that could lead towards delinquency rates at least coming up some?
Yeah, well, I think, we don't have the full picture of jobs yet, but, it sounds like January, there were over 100,000, 116,000, I thought was the number that was quoted from other data points last week, related to job losses. And I think there's an intense amount of economic pressure on the FHA borrower specifically, with the rising cost of just living, and any trip up in their ability to keep their ongoing job is going to, create a huge problem. And many of them have gone through every single piece of loss net. So when we see a file, we have seen like every attempt thrown at trying to save the home, trying to do some kind of modification. But we're at the end of a lot of that opportunity, especially when we're seeing this negative equity situation. So there's a lot of financial pressure. There's been a lot of debt taken out in other places, definitely student loan debt, definitely car debt. We're seeing it in our collections practice as well, and vehicles and other types of debt categories. But I think there's a ton of economic pressure on the FHA borrower at this moment, and the delinquency rates are higher in that portfolio without a doubt. And so when we do see, non-FHA or Ginnie pools come through, it's usually a situation that happened pre-pandemic that simply all of the patching through loss mitigation couldn't possibly fix, like a fundamental shift in the income situation for that family or for that borrower. But so it's really the worst of the worst cases that end up coming through. It's not situations where it's like, oh, well, if we just went back to pre-loss met. So these are real numbers. They're as real as they get. And I think it is concerning that vintages originated after 2022 are at risk. And I think that was just probably a result of just such a high appreciation rate, maybe glossing over, with so much value, sometimes things get glossed over in the underwriting process. It just happens. And there's an insatiable hunger to keep filling up those mortgage, originations. I get it. You have a business to run, and you're built on all of that. But I'm not sure the story of seeing negative equity in a later vintage is kind of concerning. And if I was, certainly an originator, by servicing, it's probably too late. But if I was an originator, I'd start looking at that and seeing if there are signs in my portfolio that I need to get in and start to see what other kinds of creative loss mitigation solutions might be possible. Certainly a vintage after 2022, depending on when it was, might have a better rate situation than something that's originated, in the last year or two where the rates were substantially higher. So there might be some opportunities there.
Yeah, for sure. I mean, I think the complexity is really interesting that you mentioned, because if I'm if I'm going out to try to talk to ChatGPT about what options I have, part of me thinks, well, if I'm looking for the best deal I can possibly get, the servicer is too, in a lot of ways. There is a moment where incentives are aligned, because it's like, we don't want to deal with this either. So if you have an idea or we have a way to solve for this, like, let's do that. And if it's like, I just want to extend this as long as possible, and AI is now my like very capable assistant to help me drag it out, inappropriately. The one thing that's going to end up happening potentially is that negative equity position could actually go away. It could be a moment in time rather than a real lasting problem. And so it's really interesting to think through. And I do think this topic is ripe for innovation, because of how many moving levers there are, how many moving pieces, and everything is unique. Every situation is unique. So are you seeing any either new appetite or new product structures for loss mitigation that are, in your mind, aligned with consumers to say, like, yeah, if you need it, it's out there, we're in an okay spot? Or do we still need more tools from that waterfall?
I think we saw a lot of change in HUD's program in 2025, and servicer adaptation to that change. It's hard to say. My vantage point is often the servicer that's struggling to comply with what's coming down from on high. So, and the struggle for servicing compliance is real. I hesitate to say let's rethink it again, because knowing what I know about servicing, like being in the trenches with my clients, both from a technology standpoint when I was at Sagen, dealing with all the loss mitigation changes that were rolling out during my tenure there, and making sure that Sagen's technology was, compliant for all of that, as well as, being on the compliance side from a default standpoint. Reinventing the loss mitigation wheel yet again is probably going to frustrate more humans than anything, because the difficulty of their systems and the lack of automation around loss mit right now, it's pretty gnarly. And there have been attempts to go in from a tech standpoint to really go through loss mit. I saw those. I saw people lost millions of dollars trying to defeat the incumbents with that, unfortunately. And to me, it's like, if there's ever a chance to come in and break up incumbency to try to help save a homeowner and or potentially fight for housing affordability, now is the time. I'm just going to call it out, because I hear that many healthcare behemoths are being called in. There's a lot of monopolistic behavior in the healthcare industry. They're getting called into the White House to say, what are we going to do? And there was some talk actually here in Salt Lake City with Mark Cuban and a member of the Trump administration, and they had this healthy debate on whether to break up some certain parts of healthcare that had monopolistic control. And certainly on the data side too, they have the same thing. They have incumbents that control healthcare records. We have incumbents here in mortgage that are controlling data and controlling the ability to be dynamic for the benefit of a homeowner. And people have to see that. They have to know that. Everybody talks about it. But if there were a time to try to go after it, if we're trying to really create some affordability, those things might need to be looked at. So I hate to say, like, don't think about trying to optimize for loss mit because it's too hard. But I feel for my clients because they've gone through as much as they can possibly do in terms of optimizing a loss mitigation program and getting it done right. And it's not an area where you can go fly by night or custom create anything for any homeowner. If you have a novel idea because it seems like this borrower has a certain set of circumstances, it's only going to last for X amount, and there's hope and optimism about what might happen being around the corner, the programs often don't scale for that, and you can't give one person a specific loss mitigation treatment at the risk of being discriminatory in the way that you apply that. So it's such a difficult area. I wish that there could be more. I think we pulled out the most magical tools that possibly could have been pulled out during COVID to try to prevent massive defaults. But the bag of tricks, I think, needs to kind of remain in place, and more changes have come, and seeing if those can help mitigate what's in people's portfolios right now, certainly.
Wendy, there's a lot of questions coming through in the chat, so I want to make sure we get to them. One is kind of the non-QM angle. So how you're thinking about impact to risk, especially given we've heard from a lot of lenders already this year, that is a niche that they're thinking about really either making a footprint in or expanding their footprint in. And within that, there's a question around verifications done by vendors. And I can answer a little bit of that one in a minute, and we'll come back to it. But let's start just in general with non-QM and impact to that space.
So the question is, will this?
You mentioned FHA and VA.
Yeah.
We started to see an uptick in non-QM. The uptick started a bit later than the FHA and VA portfolio vintage. Is anything coming through yet on the non-QM vintage, like issues around like defects in the loan or borrower default that we want to be thinking about?
You know, not as much. We haven't seen many. I haven't seen many defects yet. At least they haven't come through. Certainly always on the lookout for them. Certainly every contested action that comes through, we highly scrutinize it to get back to our clients with as much in-depth perspective on where this came. If it's been repurchased, is a repurchase risk, et cetera. So I try to do a real thorough root cause when I see. I haven't seen anything specific to non-QM that's like, oh, alarm bells are off here. We might have a problem systemically in how we've been underwriting or how we've been like dealing with our risk. I do see a high level of like what I said earlier on, it's the entire portfolio is just people challenging every single piece of it. Very difficult once it gets into that pretty gnarly space. But I'm not seeing any more risk on those portfolios than the Govy.
And I think, so the other question that was in there was around whether or not it's, in your professional opinion, okay to trust a vendor's attestation from a verification standpoint on non-QM versus needing error and omission coverage. I need to double check, fact check myself. I don't know that we have, insurance or coverage rather, at Zactus, but I know for sure all the automation that we do, the attestation, to Danny's point, having fraud checks, that's another tool in our back pocket to make sure that we are reviewing a lot of automation to eliminate that risk. But I'll follow up on the E&O side, because sometimes I know companies do carry their own coverage, excuse me. But do you have an opinion there as far as, is the lender at risk in allowing that process to take place with a verification vendor when it comes to non-QM loans? Or do you feel like, there's enough there that's not necessary?
I think it's the risk profile. It all depends on the details. I'm very much about the nuances and the details, and I can't just say all vendors are the same. I think that you have to look at your vendor and you have to look at its viability. You have to dig deeper into how it's doing its verification and how it's doing its compliance and controls, and making sure that it's got the right professionals at stake. I think, if they are insurable on that piece, it's also very, very helpful, and seeing an increase in the amount of insurance and all things. I mean, frankly, a lot of tech companies that are promising to, help with the process need to look at insurance. There's a lot of activity around getting insurance for certain, reps that occur throughout that process. And there's insurers that are willing to come into this. Honestly, they are, if they feel like they have a handle on what the technology does and what the risk exposure is, and they can see that they're solving a real practical problem with this technology. I think it's a good question asked, certainly. Like, you can provide me the verifications all you want, all day long, but how insurable is this? Have you explored that? Why haven't you? Talking more about the nuances of how the vendor does business it's never a bad thing. It's always good to really understand your vendors to the extent that you can, certainly.
Yep. Great answer.
I want to make sure we come back to some of the questions in the chat, but you just unlocked kind of the topic I was hoping to ask you about in the sort of next category, which is, all right, we talked about individuals using AI to try to help understand their loss mitigation options and interact with their servicer. Let's flip that. What are you seeing for tools? Is there anything happening to kind of lower costs? Or, you mentioned some agentic AI options coming in and really, consumers receiving information differently. Any impact there? Are they able to, work easier, quicker at night, in the morning? Like, I don't know how you're looking at it from a risk perspective, state or federal, for using those agentic AI. But if they're going to do it, should we be doing it?
So I think I'm seeing more interest from mortgage servicers and certainly lenders to look at agent opportunities. I think the best practice is to pilot your agents within your own internal ecosystem, within some of the practices that you're doing or business processes that you're running that are not consumer facing, and just getting to know how agent technology works. And then thinking through what problems you want to solve with agent technology, and deploying agents in a highly tested environment in certain places. Now, we've seen agents come out, in certain settings that have very limited utility, and that can frustrate your consumer more than anything. So I really don't think agents are quite ready for anything consumer facing and have a limited utility unless they're thoroughly tested. I do know that there's a lot of testing that's going on right now, and there's a lot of folks that have adopted and are saying more yes to these initiatives. A lot of people are very quiet about it, as they should be, because it can give any kind of financial institution that's in mortgage a completely competitive advantage. And so everybody's thinking about it. Some people have signed engagements. They are actively piloting. They are actively looking at problems they're going to solve with the agents. And there's all sorts of different problems that come up in loss mitigation, certainly, and default. I don't see as much activity, or I'm not hearing about as much activity in those places, but it doesn't surprise me, because typically the technology light doesn't shine on those places ever. And so it's not surprising to me that they're not probably embracing that, and they all view it as very high risk, extremely high risk. And so it makes sense that keeping humans in the loop when it comes to a loan that's in default makes a lot of sense. And the systems that are underlying all of that might not be primed for an agent, because data normalization is kind of the first step for that. All of that said, I don't know exactly how long ago it was now, 2 weeks ago, that the open Claude, open source technology called Open Claude, which I think was called Claudebot for a minute, and then it was changed to Moltbot. Now it's called Open Claude. I just watched an interview with the creator, the actual developer of that tool on Y Combinator. It's fascinating. He's a very interesting, intelligent human, and he just launched this thing out into the wild. It's open source, and one of my favorite podcasters, and I say one because you guys are really my favorite podcasters, but one of my favorite podcasters talked about using this technology, and it's just basically giving them API keys and all of your keys to all of the information that it needs to do something. And these agents were created via Open Claude, and created the entire content for their podcasts for like a week. Everything, and interacted via email with every guest, created summary of everything. I think about the power of these agents, and I could see a borrower who is financially savvy and tech savvy, maybe jumping in, giving these agents a whole bunch of information about who they are to either apply for a home loan or to apply for loss mitigation, and interfacing with their loan officer or with their mortgage servicer using these agents. And I talked about this a little bit last year at an NCBA event, which was just a debt collection. Not just a debt collection, but in a different kind of context. And a lot of debt collectors had indicated they're getting approached heavily by these agents, by consumers. So one of the things that I think servicers should be working on for sure, even if they're not going to benefit from agent technology in the default space, is figuring out readiness for dealing with agents as they approach from a consumer angle. Because there's a lot of risk in that. There's FDCPA risk that needs to be accounted for. There's authentication risk. And then there's also that desire to be customer friendly and customer first, and meeting the customer where they're at. And highly tech-enabled customers are going to find their way into these tools. And so if you don't have a readiness path, I think it's some servicers right now, it's like, still, we only communicate via phone call. We only communicate via fax. We have very limited email communication. There's only certain emails that can be sent to certain people. And the communication struggle is very, very real, depending on what system you're in. And it's not real time by any means. And getting on the phone is not the preferred method of communication, certainly for a number of people in younger generations. And so they're going to want to use these tools to figure out, and they're going to declare these tools as their agents at their own peril in some circumstances. And it is a high risk environment. And I think it was a risk I saw earlier, but once I saw this Open Claude, I was like, oh, good grief. Every compliance attorney over servicing or debt collection needs to be ready for this and get a plan together on how to mitigate the risk.
Do you think that risk, we talked a little bit a minute ago about how you interact in loss mitigation, kind of agnostic to AI, just how you interact in loss mitigation, how you travel through especially a negative equity situation. Is the regulatory landscape different for that than what you just mentioned, meaning between the CFPB and states? Or would you advise clients to be like, look, whether you're dealing with these negative equity situations, loss mid, or your AI innovation strategy, you got to look at the state versus federal landscape as one, analysis? What are you seeing between that dynamic, and how should your clients be thinking about it?
They have to definitely look at both federal and state in all circumstances. I think what's going to happen is we're going to start to see state laws that have been enacted from an AI standpoint become effective, right? There were a lot of laws that were enacted. Colorado's law, for example, which is the biggest one right now in AI, is effective June 30th. There are certain exemptions for banks in that law, but IMBs were not exempt, and there was some rulemaking, and it's coming out. In California, there's a whole series of laws that are effective throughout the entire year of 2026. There were some in 2025. And then we've got a Texas law that was effective in January of 2026. Now, what the administration tried to do in the middle of December is, and through executive order, basically say, we're going to attack all states that attempt to regulate on this technology side, and we're going to fight. But the problem is they have to get an actual court order. They have to actually finalize that fight before these laws are effective. So right now, the laws on the state books are going to be effective, absent court orders that stop that. And once those court orders come out, we will definitely see the headlines around it. And lending from a state perspective, I mean, the AGs are they're really gearing up, and they're really, with the absence of the CFPB as a mechanism of at least supporting the broad initiatives, they're focused, and they will jump in when they see harm that's created by the misuse of AI tools. They're going to favor the consumer because that's the side that they're clearly on, and they're going to have to, they'll use the federal laws. They'll have the power to do that, as well as what their state laws are. So the simple answer is both, and your compliance and legal professionals, if they are missing one and not the other, they need to be looking at both simultaneous.
Just seems like a lot for people to be looking at, Wendy. I mean,
well, if you use AI to help you, it can be helpful.
But be careful what you use AI for, because you don't want to get in a bot-to-bot war. Got it.
Yeah, exactly. Well, that brings me to the Malt book, which was the
okay.
literally
You read my mind.
All the AI agents were allowed to kind of jump in and just look at it. Create a guest account. You don't have to put in any credentials. It's open source. Don't put anything into OpenClaw or into Malt book. But supposedly it is a bunch of AI agents communicating with each other. And it's not clear how many of those agents were directed by their human counterparts. So it's not really purely like, is this really a study on what agents do without humans in the room? Like, you have to take it with a grain of salt, but it's worth looking at, just if you haven't used agents or you haven't thought about them. I think about them in the law all the time, because there's a whole category of law. It's called agency law. And I don't know how many tech people programming these have ever read the restatement of agency second. I mean, or right. Third, or anything to do with agency law. But like, there's principles in agency law that I just think about and I say, wow, if I had that thing out there doing this, I could be on the hook for that kind of harm. And what AI can do is quite a lot. And as a lawyer, certainly I would not want AI giving advice to my clients, because my law license could be in jeopardy, right? And so like, that human control over agencies and what people are willing to put into open source tools that haven't been tested is quite dramatic. And that's going to trigger more law. I have a feeling that's going to trigger the move to safety, because we've just kind of unleashed, it's like another level of release beyond what occurred, back in November of 2022. We're seeing this next level. And I think if you haven't seen, OpenClaw or Malt book, it's worth taking a look.
Wendy, it makes me think of how regulatory frameworks are going to keep up the same way that the rest of us are just trying to keep up with AI changing at such a fast pace.
Problem. That you nailed it, Sasha. I think the problem is we have too many lawyers and not enough engineers in our systems of government to actually engineer laws that work. I think the engineering of law is just as important as like the policy behind it, because you can have laws that engineer into a dead end that create so much inefficient bureaucracy. I'm just going to say homeowners bill of rights, prime example. Bill of rights or mediation programs that were enacted like in Washington State back when I was there, that would just dead end to like nothingness. And it was like, you have to consider this as a system and how the system has to work with the trade-off of all the different players. legislatures these days seem to have a complete lack of appreciation for that engineering and that partnership with the professionals that have to actually comply with it. Unfortunate. I'm always the optimistic, though. I think getting younger engineering-minded lawyers enabled by AI into the legislature to help craft the solution. You can draft legislation faster now than you ever could before. So why couldn't we enact it faster if it's the right thing?
Right.
Yeah, I love that. Jerry, any last questions? Because I know we're
No,
up at
thank
time.
you. I wish we had more time, but good news. You'll be back in March, and we will
You'll
have
be
more
back.
time.
Looking forward to it.
We'll have
Thank you
lots to
both.
talk about, especially with trigger leads coming into effect. So thank you again, Wendy, for being here. Thank you again to our sponsor today, as Jeremy mentioned at the top of the call, Accelerate, for supporting today's conversation. Next week, we are joined by Peter Bannister, who is co-founder and chief revenue officer at Mova.ai. That is a business communications platform that monitors and trains on calls, texts, and emails between customers, AEs, business partners, and call centers. So really excited to have him here next week with us, sponsored by Relku. And we look forward to seeing you next week on Now, Next, Later. Thank you.
Thanks, Sasha. Thanks, Wendy.